Hello and welcome to Asking for a Trend. I'm Josh Lipton, and shares of Hims and Hers Health, they are dropping despite a beat on the top line and a better than expected outlook for the first quarter. Here to discuss is Hims and Hers Chief Financial Officer, Yemi Okupe. Yemi, it is always good to see you. So you did just report results. Initially, it does look like investors are disappointed here in the after hours. Yemi, but walk us through the results, the quarter, what's driving the business.
Yeah, thanks for having me. We're seeing our model, which centers on providing access to personalized products and delighting subscribers through exceptional service, really resonating incredibly well with consumers. This is translating into very robust business performance. So in 2024, we ended the year with over 2 million subscribers on the platform, of which 1 million or over 1 million were opting for personalized solutions. We saw EBITDA margins more than double year over year to 12%. While also growing revenue 70% year over year to $1.5 billion.
Yemi, I think what everybody wants to know is what's going to happen with compounded GLP-1s, right? As we now know, the FDA has said that the shortages are over. That means, at least in theory, that you all will not be able to sell compounded versions anymore. There had been some question of whether there would be some sort of legal dispute about this. Where are you guys in that whole process? And if you can't sell them anymore, what's that going to mean to the results this year?
Yeah, I think that there's a lot of excitement around weight loss, and understandably so, just given the obesity epidemic across the country. Our aim at Hims and Hers is to build a robust platform that's able to treat multiple specialties. And our aim is not to necessarily just be a weight loss company. That said, we do view having an evolving weight loss specialty as an important component of helping fulfill our mission of helping the world feel great through the power of better health. But we view it as an additive to what's an already very strong and robust non-GLP-1 business. So to contextualize our 2024 results, of the $1.5 billion of revenue that we delivered, $1.2 billion of that came from non-GLP-1 related sources. Also, prior to launching GLP-1s, we achieved positive net income as well as positive adjusted EBITDA. And so while we're excited to have 200,000 subscribers join our weight loss specialty over the course of the last year, it's also important not to lose sight of the other 2 million subscribers that have signed up for non-weight related businesses.
All of that understood. I don't think I got an answer to my question there, Yemi, as to what you guys are doing with the compounded versions of GLP-1s, whether you'll continue to sell them, and what kind of sales numbers you expect from those products this year.
Yeah, it's a great question. So our objective is not to disrupt or circumvent any type of regulatory standard or bodies that have kept consumers safe for decades. So we do fully intend to abide by all regulatory requirements, and when necessary to do so, we'll remove all commercially available dosages of semaglutide from the platform. That said, we are confident that even in the absence of commercially available dosages of semaglutide, we still have a very robust weight loss offering. Our oral-based weight loss solution that launched in 2023 was able to scale to over $100 million run rate business within 7 months and is now offered for as low as $69 per month. We're excited to bring liraglutide to the platform later this year. And also, we do expect to, where it's clinically necessary, offer personalized dosages of semaglutide. And so all of those products come with the benefit of high-frequency access providers, access to our tools, and other benefits on the platform. And so we're confident that even in the absence of commercially available dosages of semaglutide, the weight loss offering will be very robust.
And just to put a fine point that on, Yemi, I do see headline dropping here that you all will pull commercial doses of copycat Ozempic. Is that accurate?
Yeah, so when we are required to do so, so embedded in our guidance is after the first quarter, assumed in our guidance is no revenue from commercially available dosages of semaglutide.
So when you guys come out with this revenue forecast for this year, it's above analyst estimates, $2.3 billion to $2.4 billion. How much of that assumes these products? And sort of, I guess, talk me through the cadence then of revenue growth through the year. Is it going to be front loaded because you at some point you're going to have to pull those doses, as you said?
Yeah, so I think we're expecting a strong revenue growth trajectory throughout the year. just because the other elements of our weight loss specialty, as well as our tenured businesses that still compose of the majority of our revenue, are expected to continue to grow. And so when we look at the value that we're bringing to subscribers across both our weight and non-weight specialties, things like exceptional service through the provider engagement, the ability to personalize medications, which will be further augmented by some of our recent capabilities, such as the lab that we recently acquired, we're confident in the overall trajectory of revenue across the year.
You know, your company's core specialties, Yemi, I think people think of, hair loss, behavioral health. What are the next big categories on your radar? What are the next potential unicorn categories?
Yeah, so I think we are setting the foundation for continued personalization across even our tenured categories. So we're seeing continued robust growth through offering consumers new avenues of value through our existing specialties. So we do expect those to continue to grow. As we've acquired capabilities such as diagnostic lab testing, that personalization we expect to get deeper and deeper in the coming years. Our lab testing capability also sets the foundation to enter other specialties that we've spoken around previously, such as menopausal support and low testosterone. So we do expect continued growth of our core specialties, which is inclusive of weight, as well as the ability in the coming years to leverage the capabilities that we've acquired to enter other specialties as well.
One of the other acquisitions you guys have made also has to do with home blood testing. So talk to me about how that is going to integrate into the business and what that will do for you.
Yeah, and so when we step back and we look at what is the vision for Hims and Hers, we view ourselves as paving the way for the next generation of healthcare. Historically, we've been able to provide consumers with the benefit of things like transparency into pricing, treatment recommendations, as well as convenience. Over time, what we've rolled out are personalized solutions. When you think around one of the elements that is very powerful across Hims and Hers, it's our closed loop data system. The ability to walk with consumers along their journey and identify what are the elements of treatment that work for them. Having diagnostic lab capabilities provides us the ability to make those treatments even more precise through being able to identify things such as vitamin deficiencies, as well as unoptimized health indicators, which we view will enable us to, when paired with our affiliated pharmacies, offer a greater degree of precision to our subscribers. Additionally, the lab diagnostic capabilities can serve as the foundation for entry into new specialties, such as menopausal support and low testosterone.
Right, and those are definitely growth areas to be sure. Yemi, finally, I do want to circle back around to GLPs for just one more question. And this has to do with the Super Bowl commercial that you guys came out with. You caught a whole lot of heat for different aspects of this commercial. It seemed like it was pretty controversial. And it's for a product that you guys aren't going to be selling in a little while. So I'm curious if you feel that was the right decision, if it got the company the right kind of attention.
Our aim was to start a discussion. And so we are transforming the way that consumers receive care. And it's not lost on us that is uncomfortable and scary to incumbents. But to say, as Big Pharma is doing, that all compounding is unsafe or legitimate, is simplistic at best, or one can argue as a disingenuous way to stoke fear across hundreds of thousands of Americans whose clinical needs fall outside of what's commercially available. Our aim is not, again, to look to circumvent any type of regulation or identify a loophole, but we are committed to ensuring that consumers that have a clinical need beyond what is commercially available do have the ability to receive treatment.
Yemi, appreciate your time today. Thanks so much for running us through the quarter and the outlook.
Thanks, guys.
Time now for what to watch Tuesday. That's February 25th. Starting off on the earnings front, we're going to be getting a big batch of results throughout the day, including Home Depot, Keurig Dr. Pepper, and Intuit. Home Depot announcing fourth quarter results before the opening bell. Analysts expecting the company's same-store sales to fall by low single digits.
Apple is hosting its 2025 annual shareholders meeting in the morning. Investors will get a chance to vote on a wide variety of issues, including diversity initiatives. That's something the company has come under fire for from its shareholders.
And Supermicro Computer approaching an important deadline tomorrow. Company is set to report its delayed earnings results. Supermicro facing a possible delisting from the NASDAQ if it fails to file that report.
Moving over to the Fed, some more commentary coming tomorrow, including Fed Presidents Lori Logan and Tom Barkin. They're speaking after comments last week from Atlanta Fed President Raphael Bostic. He told Yahoo Finance he's not taking anything off the table when it comes to interest rate cuts at the next Fed meeting.
And taking a look at the economy, we're going to be getting the monthly consumer confidence reading for February in the morning. Economists forecasting confidence to dip compared to January to 102.7. This coming after last week's consumer sentiment reading, where we saw long-term inflation expectations surge. Stick around, more Ask You for a Trend on the other side. U.S. stocks closing mixed with the NASDAQ and the S&P 500 sliding as tech lags. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Josh, I will remind everyone that the second half of February kind of has some bearish seasonality. Right now, in reality, we are seeing a slow motion breakdown. Nothing to worry too much about, nothing to write home about, but there are some warning signs. This is a 6-month candlestick chart of the S&P 500. I'm using candlesticks because it's going to show the close of the day and the relationship to the 50-day moving average. We just got to close below that. So that's a significant reference point in the market. I'll zoom in. This is a 2-month chart. Also want to show what's happening with the NASDAQ. That is well below its 50-day. It closed below that on Friday. And finally, here's the Russell 2000. This is going to show you the 200-day moving average. It closed below that just a little bit Friday, and now it is down below. So we are just kind of incrementally breaking down. And so that was my little warning there. Now, this potentially, let me just show this chart right there. We go. So potentially this has a potential to reverse in the month of March, and we could be on our way to new highs. But so far we have seen this kind of reflected in the returns that we've seen so far in February.
And of course, February nearly over, nearly in the rearview mirror. What do we see now? How's the Mag 7 been doing?
All right, let's take a look at the Mag 7 because we got some Mag 7 madness. I'm going to show you a heat map of the performance of the mega caps since the beginning of the year, and there's going to be one stock in there. There we go. All right, these are the mega caps. If you're going to look at this, Meta is up 14%. We've seen a number of these issues drop below the unchanged line. Look at that, Berkshire Hathaway up 10%, but Tesla down 18%. Apple, though, has been doing well. Over the last month, it has bounced off its 20-day or 200-day moving average. It is up about 11% right now. So that is a positive. But meanwhile, Amazon is down 6 days. Meta is down 5 days. Remember that we had that 20-day winning streak, and that was pretty recently. Here's a year-to-date chart. Well, that is now 5 days to the downside. So kind of a reversal of fortunes that we're seeing here. Now, I want to get to NVIDIA. Everybody's awaiting those earnings. Just had an interesting conversation with Lee Munson over at Portfolio Wealth Advisors on stocks in translation. This is what he had to say about the AI trade in general, not necessarily NVIDIA, but take a listen.
Look at big enterprise places like a Salesforce, like an SAP. Look at places that are going to easily say, we thought it was going to be late 2026, but guess what? By the end of 2025, we're going to be able to provide your enterprise a bolt-on AI doohickey, as we'd say, that's going to make a railroad company have logistics on a way that we can't even imagine. You know, it's the same thing and we're going to see a renaissance in industrial America where it's, if you're building things or making things, you have to get something from here to there. Whether you're a large-scale home builder or you make aluminum cans, AI is going to be able to help streamline that and increase productivity because GDP equals hours worked times productivity.
So maybe the big trade isn't necessarily with NVIDIA. We just need to wait a little bit and see what kind of productivity enhancements it brings. And that's not necessarily the near future, but kind of a year-long story. And we definitely have to watch productivity there.
Berkshire Hathaway, by the way, you mentioned that.
Over the weekend.
Not a Mag 7, but close.
Let's just look at this chart here because Berkshire is kind of the sleeper. It's maybe the Mag 8 there. Well, guess what? That's a record high. $747,000, 486 per share. So the number is big and impressive. All right, we got to get to our third one. And I have been tracking the international wave. We've seen a lot of outperformance in the DAX from China, but we got BABA earnings overnight. So that's why I'm saying BABA buy. But I don't think it's the end of the world for BABA. This is a 10% decline, worst in a few months. Let's take a look at China if we can find that. There we go. This is going to be a 1 month, so let's get the year to date, and you can see the incredible outperformance here. Even after the 10% decline, BABA's still up 52%, lots of green here. But a lot of people are going to be asking themselves after this latest miss, is this buy the dip or do I wait?
I was going to say, gee, I'm a trader. I'm waiting. Buying opportunity, frustrating top.
Yes, frustrated top. I like that. Here's a 5-year. Well, you can see in the 5-year context, we are still in the early innings of anything approaching a recovery to those pre-pandemic highs or the early pandemic highs. So this stock has a long ways to go. I don't know if it recovers immediately, but I would be surprised if China doesn't kind of pull a rabbit out of the hat and make some additional gains this year. I don't think the China rally is over, but it is notoriously difficult to predict.
Berkshire to BABA. We covered it all.
You got it.
Thank you, my friend. Well, the NFL, MLB, NCAA, and NASCAR have thrown their support behind a bipartisan bill that gives local law enforcement the authority to disable drones above large sporting events. Current law empowers federal authorities to disable drones for certain major events, but that ability does not extend to local and state authorities. Well, joining me now is Matt Higgins, RSE Ventures CEO and co-founder, and PDW co-founder. Matt, is great to see you. So listen, you're very, I know, Matt, you're involved in all things drone. You think about where this industry is and where it's headed. There are those recent headlines, Matt, I do want to start there, that are interesting. You have these major sports leagues, whether it's the NFL, the MLB, that are apparently supporting this bill, Matt, that I guess would limit the use of unauthorized drones over sports stadiums. What do you make of that, Matt?
Yeah, I mean, this shouldn't be controversial, by the way. I think most Americans presume this is already happening. So let me lay it out. Simply put, already there's a perimeter around major stadiums where you can't fly a drone. That makes a ton of sense for a variety of reasons. But the problem this legislation is addressing is unless there are federal law enforcement officials on site, nobody can do anything about it. So if you spot a drone and your local law enforcement, you can notify your colleagues, you could attempt to track it down, figure out where the operator is, but you can't actually interdict and use these tools that are out there. So this legislation takes an obvious step and basically gives permission to a local law enforcement to operate an interdiction scenario, whatever that is.
I guess my question would be then, does local law enforcement, do we know whether they have actually the technology and the tools, Matt, to go ahead and disable an unauthorized drone?
Yeah, I mean, that is the big question. So going back in my career, I helped oversee the rebuilding of the World Trade Center site. So I stood underneath those towers soon after the attacks, and I said, how does this happen here? And honestly, once I started interacting with drones around 2015, I said, my God, this is going to happen again, except the next time it won't be planes, it'll be drones. And so we are at the moment unflanked. We don't have a nationwide system to defend our venues, our buildings, our cities from an incoming terrorist drone attack. So passing this legislation is just one obvious step, and I want to commend Senator Cotton and Secretary Hegseth for pushing it forward. But what we actually need now is for an entire government to rally together and begin to not only implement, but develop the tactics we need to stop an incoming drone. What works in the military battlefield, maybe jam a signal, interdict a kinetic force, doesn't work in the middle of New York City. So we need a whole wide variety of solutions, and then we need to train local law enforcement about how to implement them.
Why don't we have that set up here and now, Matt? What are the reasons for that?
I mean, honestly, it wasn't prioritized in the previous administration. I give President Trump a ton of credit, and also Secretary of Defense, for saying this is one of our top 17 priorities. I think number 7 on the list was counter UAS. We just haven't been able to organize ourselves, and the threat is very real. And so the second reason is it's pretty complicated. It's not like there's a single solution. So I'll give you an example. There's a company called Fordham. It has basically a catch and carry. You see an incoming drone, you go after it. If it's unfriendly, you go ahead and use a net system, and then you deliver it to a designated spot. But that's just one solution. There will come a day where we have autonomous drones that are sending a swarm towards a target, and you're going to need an autonomous solution. So can you imagine how complicated that would be to train law enforcement in every city on these ever-evolving tools? I was recently in Poland, and I was meeting with troops and understanding what's going on, there, and the tactics are changing like every single day. So this really does need to be a national priority. This legislation is the first step.
Matt, always great to see you, to have you on the show. Thank you, sir.
Thank you.
Coming up, we're looking at a new note from UBS and why the firm is overweight on Europe. We're asking for a trend that's right on the other side. For our chart of the day, we're looking at a new note from UBS and the reasons to be overweight on Europe. Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
Yeah, we've had sort of a drumbeat of investors talking about this. Andrew Garthwaite over at UBS is the latest to enumerate some of the different reasons, and valuation is the reason behind our chart of the day. So UBS looking at the gap in valuation between the MSCI sector-adjusted 12-month forward price-to-earnings ratio relative to the U.S. So this is the valuation gap between the two. You've got the average here, the dotted blue line, and then the standard deviation, the sort of normal range, is the green dotted line here. And as you can see down here, basically what we have is that we have not seen this kind of standard deviation, basically, or this kind of gap, I should say, going back to 2007. In other words, put another way, the sector-adjusted European stocks are trading at their lowest versus the United States going back to 2007. One of the many reasons that UBS enumerates as ones to get in on European stocks right now, they also talk about that there has been an improvement in relative earnings revisions in Europe, that has not been priced in, however, and so that should provide an upward catalyst. And speaking of catalysts here, we recently spoke to Christina Hooper. She's Chief Global Market Strategist at Invesco, and she also likes Europe right now. She told us why.
The United States is in a very good place, but you don't need a great economy for a stock market to perform well. What you need is positive surprise, some kind of catalyst. And what we likely have in terms of catalysts in both the UK and Europe is slightly improving growth picture and, of course, the potential for significant rate cuts this year, which we know we don't have in the US.
So Christina also giving some reasons to potentially buy in Europe. And the backdrop here in the U.S. is that valuations are relatively rich, according to many investors. Not so in Europe, Josh.
All right, thank you, Julie. Now let's take a look at what's trending after hours here. Shares of Riot rising as full-year net income topped Wall Street expectations. Company's Bitcoin mining revenue also beating estimates. Looking ahead at 2025, Riot highlights it's pursuing opportunities in the AI and high-performance computing sector. Moving over to Cleveland Cliffs, those shares are falling after hours. The company reporting results for the fourth quarter slightly missing on revenue estimates, coming in at $4.33 billion. The U.S. steel producer sees capital expenditures of about $700 million for the year. In 2025, steel unit cost reductions of about $40 per net ton compared to last year. And finally, shares of Trex Company higher after reporting EBITDA for the fourth quarter, beating the average analyst estimate. The decking company posting net sales of $167.6 million for the quarter, which fell 14% year over year, but still exceeded expectations as the street was looking for $160 million. Let's wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.